We are back with another deal of the week breakdown review. And in this week, I am in a different location. Of course, you guys can see the beautiful skyline of Miami behind me. I'm back in my Miami condo for a little bit of time. And while I get the office situated, I'm here giving you guys a nice view instead of what, I typically have on my bookshelf and whatnot. But I have a pretty cool deal that I want to take you guys through, primarily just because we have a lot of our investors that own primary residences. They have a house where they live in themselves, and then they want to go and they want to scale their real estate portfolio buying investment properties. One strategy that we don't get to talk about too frequently, especially just because interest rates haven't been as low as we need them to be, is talking about buying one new primary residence every single year. Now, I have a lot of investors that actually utilize this strategy because of the fact that it allows for you to buy one new house to live in every single year. And what ends up happening is you end up saving significant amount of money on down payment, the money that you spend to buy the house plus closing costs. You get significantly better interest rates. And it's a strategy that allows people to scale their portfolios with less money. The perspective that I always like to look at this from is when you have one primary residence that you're purchasing, you can get into it with a minimum of a 5% down payment. Or as a first-time home buyer, in some cases you can get 3% down. There's also other programs like down payment assistance. There's FHA financing that allows you to get in at like 3.5% down. So it really ranges in terms of what's actually possible, what you have the ability to be able to do. But in this situation, this investor locked in a new primary residence. They only had to put 5% down. And instead of going and buying this as an investment property where you'd have to come in at like 15 or 20 or even sometimes 25% down, you can really divide that into a lot of different deals. Now, the piece to think about here is that when you buy a new primary residence, you are going to be signing loan documentation that's going to say that you are living in this property for the first year. The paperwork is going to specify that your intent is to move into this house for at least the first year. Now, what happens after year one, the bank really doesn't care about. You have the ability to, go and do whatever you want to do with your property after the first year. But ideally, you want to commit to living in the house for the first year. I have had situations where investors will move out prior to the 1 year mark, for whatever sort of change of life circumstance reasons, as we like to call it. Change of life circumstances that come up, whether it's a job relocation, something comes up with family, etc. You have the ability to still move out of this property once you've bought it as a primary residence, but understanding that your intent is to move into the house for the first year. So this deal was in Katy, Texas, which is an interesting market. I know Katy, Texas has had a lot of properties that hit the market. There's a lot of builders in Texas and around Katy, Texas that build houses, but it's a relatively more affordable location for individuals wanting to get really big properties because this property is honestly really big for the price point, especially for us compared to California and Florida. It was a single family house. It sits on a 5,700 square foot lot, and living space was around 27, almost 2,800 square feet, which is pretty big. The total bedroom and bathroom count is actually 5 beds, 2.5 baths. It's bigger than most deals that a lot of our clients go on. And it wasn't on the market for a long period of time. It's also one of those things to consider. When you want to buy a property that's going to be the hot home of the market, you can't expect to try to have massive savings. You can't get 20, 30, $40,000 in seller credits or negotiating with the seller simply because of the fact that the house has been on the market for a shorter time. There's going to be more people that want to buy, and it becomes a little bit more tricky to be able to get those things through. So this situation, you'll kind of see how that happened. The cool part though, the house is still overappraised. Now, this client had over a 740 credit score. Something to note is we all love credit scores. We all love talking about amazing credit scores. If you're one of the people who's in the 800 club for credit scores, we know, people like talking about that. But in reality, whenever you're over a 740 credit score, you actually are already going to be in the best pricing bracket for all kind of financing. For the most part, I'd say like 95% of loan programs, you're going to be in the highest pricing bracket when it comes to having a credit score over 740, which was the case for this client. And so the kind of financing that we ended up doing on this was conventional financing. You guys know that I talk a lot about conventional financing, and conventional financing is essentially the type of financing that allows you to get into a property with the lowest out of pocket possible. You have a primary residence where you're moving in, you have a second home where you plan to use it, for yourself, or you plan to use it as an Airbnb, and then you have investment financing, which you can declare for specific conventional financing. And so it ends up being a little bit different, but in this situation, we did conventional financing as a primary residence moving into the property. Now, sales price on this property was actually, so I said property type here, but property type was a single family home, or SFH for short. The property purchase price was actually $335K. I love those Texas prices, but I do not like those property taxes that come back to us. The appraised value came in 5,000 over, so it actually came in at 340. Client walked in on day one with $5,000 in equity. We ended up only putting a 5% down payment on this deal, which came out to $16,750. Remember, the down payment is only based off of the purchase price. It's not based off of whatever the house appraises for. And in situations like this, if your house does over appraise, you actually don't have the ability to use that equity on day one. Like, we wouldn't be able to say, hey, because my house is worth more, can I put less money in? No, I wish it worked that way. Banks obviously are going to be the most conservative, and so they don't really let us do things like that. I wish that they did. Honestly, it would be a much better structure for clients here. So we ended up doing $16,750 for the down payment. Interest rate. This was kind of right before interest rates started to really fluctuate here, but we had a 6.875% interest rate. I cannot write today. We did a 30-year fixed term, which is still the most common today. Most people are not really doing adjustable rate mortgages. The principal and interest came in at $2,090 with 68 cents. Homeowners insurance here came in at $267 with 65 cents. Property taxes came in at a whopping $480 with 80 cents. However, in Texas, you have the ability to claim something called a homestead exemption, which actually allows for you to waive property taxes or even significantly lower your property taxes. Again, because our client had really good credit, PMI came in super low at $87 a month. Now, I talk a lot about PMI. PMI is private mortgage insurance. It's basically when a bank is giving you a loan and you're putting less than 20% down, it protects them in the event that you stop making payments on your mortgage. In order to get better pricing on PMI, you need to have a better credit score and or put a bigger down payment. But in this situation, saving the extra 15% down is like almost $50,000. The client saved the 50 grand instead of coming in with 20% down just to save 80 bucks a month. It wouldn't have made sense. Total monthly payment on this came in at $2,955 with 15 cents. I forgot to include the HOA as well here, which HOA is not as common, but HOA here was only $28 per month, which relatively minimal. Most HOAs are actually more expensive if you buy in like a condo building, for example. Total closing costs were just a little bit more expensive because of the time of the year for when this client purchased his property. However, we did get a pretty large chunk of adjustments and other credits back simply because of the fact that he is buying the property and then the seller is paying him for a portion of the property taxes that are going to be paid. You guys will see that come up here in just a second. Seller credits came in at $950. I still cannot write today. And then adjustments and other credits, like I was mentioning, is actually money back to the buyer from the seller. And it's based off of the time of the year for when you buy. And it was actually $5,273, which is a ton of money. Total out of pocket came in at $29,000. So just shy of $30,000 for this client to purchase this property. And of course, we're going to be able to refinance him out as soon as interest rates start to come down. Normally, my rule of thumb for making a refinance make sense is for us to be in like the 1 to 1.25% range below where you're at today. And that's typically where it'll make sense for a refinance. Of course, when it comes to refinancing, I always tell my clients, math is math, and the math has to make sense in order for a refinance to make sense. Because if we refinance now and we know we're going to refinance again in, let's say, 12 or 18 months, we need to make sure that the money that you're spending on a refinance is going to be recouped or paid back in the savings that you are going to get from this monthly payment difference. So yeah, it just goes to show there's still things that are possible even when it comes to not having a ton of seller credits. And this client's out of pocket ended up being less than total of 10% from his purchase price. I think we could have gotten it even lower, but being that we needed to be competitive, we ended up not being able to negotiate some money in seller credits, and overall it was still a great deal for our investors. So it just goes to show you guys, I still have people that are purchasing primary residences. I know the market is all over the place. We still have people buying investment properties. The market's going to continue to change over the next 12 months. And the one thing we can't control is what the market is going to do. But the one thing we can control is that we can purchase the properties now. We can take advantage of the market that we're in and ultimately just try to do the best that we can in negotiations, save as much money out of pocket up front, and have an overall better deal that will work for the long term. So I hope you guys found this deal of the week informative. I know it's a little bit different than the investment ones that we're used to, but yeah, I will see you guys in the next deal of the week video. Peace out.